We're always told that successful investing is all about capturing the upside, right? Chasing those big gains. But what if that's completely backward? Today, we're going to dig into a really surprising truth. What if the real reward you get from the stock market doesn't come from chasing gains, but from being willing to endure the pain? Think about it. The basic advice is always to maximize your gains and minimize your losses. It sounds like a no-brainer, but what if the hard data actually shows that the very act of trying to avoid the downside is what costs you pretty much all of your long-term returns? It's a paradox, and we're going to unpack it. So this is it. This is the core idea for today. Forget chasing potential for a second. The data is just overwhelming on this. The extra return, the premium you earn from stocks, is basically a direct payment for one thing and one thing only: your willingness to stomach the downside. To really get our heads around this, here's the plan. We'll start by looking at this problem from a new angle. Then, we'll see how you can literally split the S&P 500 into two different pieces. After that, we'll dive into the hard data, explore the psychology of why this all happens, and wrap up with what it all means for you as an investor.
The ultimate investor's dream is pretty simple. Get all of the market's gains with none of the losses. And there are all kinds of financial tools, like options, that promise to do exactly that, to insure you against a market crash. But here's the thing, just like any other insurance, it is not free. And the price you pay for that safety, well, that's where this whole story gets really, really interesting.
So how can we actually prove this isn't just a theory? Well, some researchers at AQR came up with this brilliant way to test it. They figured out how to conceptually and surgically split the S&P 500 index into two totally separate parts, one that only has downside risk and another that only has upside potential.
And here's how it works. The easiest way to think about it is like an insurance market. The first part, let's call it the insurer, is kind of like selling insurance. You agree to take on all the downside of the market, but in return, your upside is capped. For taking on that risk, you collect a fee, a premium. Then you've got the second part, the protected. This is the person buying the insurance. Their potential losses are limited, but they get to keep all the potential gains. Of course, they have to pay that premium for the safety.
This graph shows you that trade-off perfectly. Look at the profit profile for the insurer. That's the dashed line. It gets hit by losses, but its gains are capped. Now look at the protected investor, the dotted line. Their losses are totally limited, but they get to ride all the gains up. On paper, that looks like the perfect deal, right? But that protection, it comes at a very steep price.
Okay, enough with the theory. Let's look at the actual numbers. What happened when researchers tracked the performance of these two separate strategies for nearly 30 years? This is where it all clicks. And this table right here, this is the smoking gun. So over almost 30 years, the S&P 500's total excess return was 7.6%. But look at how it splits. The insurer component, the one taking all that downside risk, captured a massive 6.3%. And the protected component, the one just chasing the upside, a tiny 1.3%. The conclusion is just unavoidable. About 83% of the entire market return went to the people who were willing to accept the risk of loss. And if that table didn't convince you, this chart absolutely will. It shows you what would have happened to $1 you invested in each strategy. See how the insurer line practically hugs the total S&P 500 line all the way up? It tracks it almost perfectly. And the protected component? Yeah, that's the sad flat line at the bottom. It generated almost no wealth over the long haul. All that amazing upside potential it was supposed to capture was just completely eaten away by the cost of the insurance. So this just begs a huge question. Why? Why are investors willing to pay so much for this upside potential that they basically end up giving away all of their returns? Well, the answer isn't in spreadsheets. It's in human psychology and something called skew.
So what's the engine driving all of this? It's something called the volatility risk premium. Here's a simple way to think about it. Options price in the fear of what might happen. But in reality, things are usually a little calmer than our worst fears. That gap between the expected volatility and what actually happens, that's the premium. It's the profit that insurance sellers make because buyers are consistently overpaying for protection.
And the reason we overpay for this is our natural human preference for what's called positive skew. Our brains are just drawn to investments that have a tiny chance of a massive payoff. It's like a lottery ticket. We're totally willing to overpay for that slim hope. And on the flip side, we absolutely hate negative skew, that small chance of a catastrophic loss, and we're willing to pay a ton of money to make that risk go away.
And hey, this isn't some newfangled idea. This is a cornerstone of behavioral finance. famously studied by psychologists Daniel Kahneman and Amos Tversky. It turns out we are just hardwired to chase lottery-style payoffs and run away from the risk of big, sudden losses, even when it's not the most economically rational thing to do over time.
Now, it would be easy to think this is just some weird quirk of the stock market, but it's not. This fundamental pattern, where the market pays a premium to people who are willing to bear the risks that nobody else wants, it's basically a universal principle. We see it in bonds, in gold, even in commodities.
Let's just quickly look at bonds. Even in the supposedly safe world of 10-year treasuries, the same logic holds up. The insurer component returned 2.6% a year, while the protected side only got 1.6%. The gap is smaller than in stocks, but the principle is exactly the same.
Now, check out gold. This one's even more dramatic. The component that took on the downside risk, it earned a 2.2% annual excess return. The component that bought protection to chase the upside, it returned exactly zero, nothing. The entire expected return was wiped out by the cost of hedging.
And let's do one more just for good measure. Crude oil, a notoriously volatile commodity. And surprise, surprise, the insurer wins again, capturing a 5.7% annual return versus just 4.1% for the protected side. The pattern is just incredibly consistent across the board. The market pays you to bear the risk that others are afraid of.
Okay, so this brings us to the final and most crucial question. Now that we know all this, what is an investor supposed to actually do? This really does create a dilemma.
So what is the big takeaway here? The research all points to a really simple but powerful conclusion. If you just can't stomach the potential downside of stocks, paying for option insurance is a consistently expensive solution. The better strategy is often the simplest one. Just own less of it. Reducing your allocation gives you the risk reduction you're looking for, but it does it without forcing you to pay that massive premium that, as we've just seen, actually accounts for most of the market's return in the first place. So, we'll leave you with this one last question to think about for your own strategy. Are you positioning yourself to be the insurer, to get paid for taking on the risks that other people fear? Or are you the one who's constantly paying the premium to avoid them? Understanding that difference, well, that might just be the key to unlocking long-term returns. Thanks for tuning in.